Hey everybody, my name is Jake. Welcome to the channel. In today's video, I want to talk about the slow path to wealth. And that's really what this is. If you're investing in a dividend growth strategy, you have to understand that you're not going to be a millionaire tomorrow. This is a very slow process to wealth. Here on my screen, I'm sharing my dividend growth portfolio here in M1 Finance. And if you're new to the channel, I break it down fairly easy. I'm investing for dividend growth so that I can one day live off of the cash flow, the dividends from my portfolio. And I'm dollar cost averaging into my portfolio every single week. Really, that's the concept that I've adopted here in my investing strategy. What I've noticed has been very difficult. So I'm here in my mid-30s, and I'm probably like you, where you may start something, but it's sometimes difficult to finish. And a lot of that has to do with instant gratification. For example, I'll maybe start to read a book, I'll start to read or watch a TV series, and I won't end up finishing it. And because a lot of times I'll get distracted by something else, and I'll go off and I'll do that. Like, that's kind of the society that we live in today. We're no longer like our parents, where we work at the same company for 30, 40, 50 years. It just isn't like that today, especially in the technology sector where I work. I work as a software sales manager, and people are constantly changing jobs. And with that constant change, and we're supposed to, accept change and embrace it. And with that comes a lot of complications when it comes to managing other parts of our lives, in my opinion, right? For example, when you're looking at investing, what I've noticed is that the more I try to change my portfolio and change things, the more diminishing returns I have. And it's not just something that I've noticed here just recently, but looking back over the last 10 years, I've invested and tried many different things. And I've tried to day trade, I've tried to trade on margin, invest in a penny stock, so many different things, because I wanted that quick win. And unfortunately, it doesn't work like that. If you want to get rich off of your dividend growth portfolio, you have to understand that you're in this for the long haul. Okay. And our society is really pushing that narrative of have everything today. Finance your vehicle on a 7-year loan, and you can get it today. Buy everything on credit. All of those things, get it today and pay later. It's really corrupting the way that we as a society are functioning. We don't have those fundamentals, those basics that we need to be successful in investing. When new dividend investors start embarking on this dividend growth journey, a lot of them react like this.
Are we there yet?
No.
Hey, are we there yet?
No.
Are we there yet?
No.
Are we there yet?
Yes.
Really?
No.
Are we there yet?
No!
Are we there yet?
No, we are not.
Are we there yet?
I had a conversation earlier this week with a coworker, and the coworker that I'm talking about here was in about his early 30s, and he doesn't know that I have a YouTube channel. He doesn't know that I'm interested in talk about finance. I'm kind of an introvert. I don't really talk a lot about my personal life and all of that. So the conversation kind of started with, well, yeah, hey Jake, how are you doing? How was your weekend? Yeah, I did this and that. And he said, yeah, I'm looking to start investing more. I might might do a house flip, and I'm looking to make some more money that way. And so naturally, I just kind of was, curious, and I asked him, well, okay, well, what are you trying to do? And he says, yeah, I'm trying to make more money. I want to retire early. The whole rat race is, it's not necessarily for me. And I said, okay, well, that's really interesting. And then I kind of, he was asking me, well, what am I doing? Am I investing or doing anything? And I kind of got a smile on my face. Well, actually, yes, I am. And so I shared with them that there's typically two schools of thought. When it comes to investing, and when I talk to people, I usually like to use the analogy of the house flip. And the first school of thought when it comes to generating wealth is you're going to buy a house, a fixer-upper, you're going to fix it up, and then you're going to sell it a couple of months later at a massive gain, right? Like, that's the goal. You buy something low and you sell it high. That's the first school of thought. The second school of thought is you buy a property with the intent to rent it out for cash flow. so that you're no longer really actively working on the investment, but rather the investment is working for you while you sleep. And so I shared that with the individual and I said, hey, you can flip houses as much as you want, but you're never really ultimately going to get ahead. Typically, when you're making more money, you spend more money. If you truly want to be financially free, you have to have your money work for you. Okay, so the person that I was talking with, he had the right idea. He had part of it where he wanted to make more money, but he didn't know what to do with that money. Okay, and so that's where I was explaining to him, okay, you can house flip, but you're going to house flip until you retire. If you build up a steady stream of cash flow from rental properties, you're never going to have to work past whatever it may be. Maybe this is all relative. Maybe it's 40, maybe it's 30, maybe it's 50 years old. And then I went on to, okay, well, the other way you could also look at it is with your investments. You can buy a stock low when it's on sale with the intent to sell it. I know a lot of hype right now is around Bitcoin, around cannabis stocks, around Tesla, a lot of things where carnival stocks, right? You're buying something at a distressed price in hopes that it will go up in value and someone else will pay more for it than what you paid for it. That's the same concept of a flip. You're buying a home, fixing it up, right? You're actually doing something and hoping that somebody will pay more for it. The other school of thought is getting dividend paychecks from your investment. You're buying a company like 3M, McDonald's, or Johnson & Johnson, and you're getting quarterly dividends or quarterly paychecks. And essentially, you're holding on to those shares and you're getting paid every quarter to own those shares. Really, so I asked him, okay, well, which school of thought resonates more with you? The buying low and selling high, or residual cash flow? And his response was a little interesting and surprising to me. He's, even though I made this very compelling example of you'll never have to work, for the rest of your life once you've reached a certain level of cash flow, he was still more set on buying low and selling high because he fixated on the low price and the high price. And so that really made me think, well, this strategy is not for everyone. The slow and steady approach is not for everyone. I love looking at Warren Buffett as the poster child for this example. When you look at Warren Buffett's net worth over his lifespan, you can see that snowball effect in action. And that's really what reminds me that Warren Buffett in his 20s and his 30s, he didn't get to where he is today in his late 80s just overnight. It is a long, slow approach to wealth when you're investing in a dividend growth strategy. So what does this mean for you? If you're in your 20s or in your 30s, for example, the sooner that you invest, the sooner you're going to see that snowball effect. And over the long term, it really ultimately depends on when you started, right? For me right now, I'm in my 30s, and so I'm having to play catch up compared to if I would have just started in my 20s, the amount that I would have had to invest in my 20s would have been nowhere near what it has to be today to ultimately reach the goals that I'm trying to achieve in my life. Okay, and so I would invite you, if you're in your 20s, your 30s, your 40s, your 50s, do the math, understand what does this mean for you. And that's the amazing thing to me here is it's so unique to every individual. There's people that follow the channel from all over the world, in Europe, in North and South America, and in Asia. Like it's so amazing to me to see the interest for this topic all across the globe and in every age group. So the sooner that you start, the sooner you're going to see that snowball effect. Another chart here, this is looking at it from a 6% rate of return. Now this is much lower than what just the S&P 500 has yielded, or the rate that it's yielded over the last 100 plus years. The average is right around conservatively 9%, including the reinvestment of dividends, 9 to 11%. If you want to be conservative, you could say 8%. Okay, but even looking at 6%, if you were to start in your 20s, the amount that you would need to invest monthly compared to somebody in their 50s to reach early retirement at 60, or to reach $1 million by the age of 65. This is what it puts it into perspective. I wish that somebody would have shown me this in my early 20s. Coming back to the conversation that I had with my coworker, I summarized it with a few final thoughts that I had from my end, because obviously we were looking at things from different perspectives, and which is completely fine. That's one thing that I've learned here with creating this YouTube channel, is not everyone is going to agree with you, and that is completely fine. I think there's an old saying that I learned in Europe when I was living in Germany, is there's many roads that lead to Rome. Many different paths that lead to success. And so what I told him was, what I've learned is there's three things that you need to focus on when generating wealth. And what I focus on my channel is generating generational wealth that I can hand down to my family. What I said was, the first thing that you need to focus on, regardless of which approach you're taking, is to eliminate consumer debt. You want to keep as many dollars in your pocket and not give away dollars to somebody else, typically to a bank, in the form of interest. So that was the first thing, eliminating consumer debt. A house, for me, for example, a rental property, that is good debt. And I've shared that in other videos. So that's the first thing. The second thing is to cut your expenses. If you're paying $85 or $100, and I use this example with him, $100 for a phone bill, you need to consider other alternatives to that. For example, the phone bill that the phone plan that I have is, I pay $15 a month for the exact same network that I was on with T-Mobile. I get the exact same coverage, but I'm paying $15 because it's an off-brand and not one of the major carriers. Okay, that was one example. And when I told him that example, his eyes were just like, we were on Zoom, and so we were video calling, and I could just see like his jaw drop. So that was the second thing, cutting your expenses where you can. And then the third thing is make more money. Side hustle, do things that are gonna generate more income for you, and then take the surplus, what you have left over, and invest it. So those are the three things that I shared with him, and those are the three things that I would share with anyone here on the channel, regardless of your age group. Look to cut your consumer debt. Look to cut your expenses, and then look where you can grow your income. Whether you're working more hours at your 9-to-5 job, you're side hustling, right? You can go and you could do DoorDash, you can start a blog, anything that you can do to generate more income, and then invest the rest. And then hopefully investing into cash flowing assets like dividend growth stocks, or other examples would be a rental property. Thank you so much, everybody, for watching the video, liking the video. If you're new to the channel, I'd invite you to subscribe. If you liked the video today, give me a thumbs up, and I will catch everybody in the next video.